Hi everyone, welcome back. In this session, we're going to start a new chapter in CA Intermediate paper number 1, which is accounting, named Investment Accounts. This is covered in chapter number 9, module 3 of the Institute material. Now, through this chapter, we're also going to cover accounting standard number 13. Remember, this accounting standard number 13 is as per the Indian GAAP. All right, this is not as per the Ind AS, which is converged form of IFRS, but this is the local GAAP that is followed for non-Ind AS entities. Now, let's start with the definition of what is an investment. All right. So in this chapter, like the name suggests, we're going to prepare the ledger accounts for investments that we are going to make, how we account for our investments. So therefore, let's start with the question of what do we mean by an investment? Now, accounting standard number 13, AS 13, defines investments as assets which are held for the purpose of earning either dividend or interest or rent or capital appreciation. These are assets, which means I might have purchased something and I'm holding it for the purpose of earning either dividend income or interest income or rental income or for the purpose of capital appreciation or any other benefit. All right. So it is anything that I hold for the purpose of earning dividend, interest, rental, and capital appreciation. So if you look at it, they've covered instruments like equity securities, because through equity instruments or preference shares, you earn dividend. They've covered debt instruments like debentures or bonds by saying that by covering interest income, they have also included investment in debt instruments, investment in bonds, investment in debentures, investment in deposits, and so on. They've also written rental income, which means if you have actually invested in a property for the purpose of giving it on rent, all right, you have purchased the land and building, you don't want to occupy that land and building for your office purposes, but your intent is to actually give it to somebody else for the purpose of earning rental income. That is also covered as an investment. That is also treated as an investment. Again, repeating myself, if you go and purchase a building for self occupancy, all right, you want to sit there and carry out your business, that is not an investment property. But if you are actually investing in a property solely for the purpose of giving it to others on rent, then that is actually going to be treated as an investment for the purpose of AS 13. It will not be treated as a property, plant, and equipment under AS 10, but will actually be treated as investment under AS 13. And anything that you also purchase for the purpose of capital appreciation is also going to be treated as investment. For example, equity shares, you need not necessarily purchase only for the purpose of dividend. You may purchase equity shares for the purpose of earning capital appreciation, which means you want to buy the share today at 100 and you want to sell it at a later point in time, say at 150. All right. So your intent of purchasing is for earning capital appreciation. What do we mean by capital appreciation? The fact that the price of this instrument that you've purchased may increase in future. You want that price to increase in future. That is referred to as capital appreciation. In fact, you may also actually purchase some land for the purpose of capital appreciation, right? Maybe you believe that a land in a particular area is currently quoting at say 1 lakh rupees. You believe that land price will actually appreciate in future, and therefore you're going and purchasing vacant land. That is also going to be treated as investment under AS 13, because your intent is for making capital appreciation out of it. So an investment is any asset which you're holding with the intent of earning dividend or interest or rental income or capital appreciation. Further, Accounting Standard 13 goes on to clarify that anything that is held as part of stock in trade or inventory is not going to be covered by AS 13, because you have a separate accounting standard, AS 2, covering it. All right. So anything, if an entity is actually holding equity shares, not as an investment, but more because the entity's business is actually to trade in stocks, then that is actually going to be treated as inventory. It is going to be treated as stock in trade, and therefore that will form part of AS2, and it's going to be out of scope for AS13. Now, in this chapter, the scope of discussion is largely predominantly on debt instruments and on equity instruments. We're not really going to discuss a lot about investment properties, that is land and building as an investment. Our predominant discussion is going to be in the form of debt and equity. You can have different types of other investments also. For example, investment in crypto, investment in land and building, investment in gold. But this chapter is restricting itself to debt and equity instruments. Now, in the curriculum, debt is also being referred to as a fixed income security, while equity is being denominated as a variable income security. Debt is being called as a fixed income security. Equity is called as a variable income security. The reason why they have said so is because interest that you're earning on debt is a contractual payment. All right. An entity is actually entering into a contract saying it will pay you 10% interest every year. All right. So in that sense, it is actually a contractual cash flow, which they are calling as fixed income. Equity, there is no contract between me and the company saying that the company will pay a dividend of 50 rupees every year. There is no such contract. It is variable in nature because if the company has profits, it will give dividend. If the company does not have profits, it will not distribute any dividend, which means I will not receive any dividend, and therefore they're calling as variable income security. Now, just as a reminder, within debt also, you can have variable instrument securities. Within debt, you can actually have variable instrument securities. Example, any instrument, let us say if it is linked to the repo rate in India, all right, say I have purchased a bond, the interest on that bond is dependent on the repo rate that RBI quotes. Okay, the repo rate is actually going to change every 2 months, right? If the repo rate changes every 2 months, then the interest that I'm going to receive will also change every 2 months. But that is still falling under the fixed income security because the cash flow, although in terms of amount is not defined, it's still a contractual cash flow. Whereas in equity, there is no such contract. Although in the example that I gave, the amount is variable, but at least there is a contract between me and the company saying that the company will pay me cash. The company will pay me whatever the repo rate is. Whereas in case of equity, there is no such contract, and therefore they've called that equity as a variable income security and debt as a fixed income security. But all I was trying to say is within debt also, there can be variable income, there can be a variable element in the form of market linked interest rates. Like example, linked to repo rate, linked to SOFR, linked to LIBOR. All right. So it can be variable within debt as well. If you've not understood, that's still okay because the institute has anyways not covered this. All right. All you'll have to remember is that debt is being synonymously treated as fixed income, while equity is synonymously being treated as variable income security. Now, before we move on to the accounting aspects, let's actually quickly discuss some features. Let's actually start with the mode of acquisition. If I, as a company, I would like to acquire any debt instrument, if I want to invest a debenture or invest in an equity instrument, typically what happens is these debt and equity instruments, they are generally traded on an exchange. All right. In the Indian context, for you to understand, you can think of it as they are being traded on an exchange. All right. So what I will do is I will have a broker. Say, for example, brokers like ICICI Direct, Motilal Oswal, Sher Khan. We have all these designated brokers. I will place an order with these brokers. I will say that I want to buy X number of shares of Reliance. I want to buy this particular bond. I want to buy, say, in 40 shares of Infosys. So I am going to place an order with these brokers. Maybe a lot of you might probably know, just like how in the real estate market you have brokers to help you in finding a property or to help you in selling a property or buying. Similarly, over here also we have some designated brokers. So I am going to place an order with them and I will say that I want to buy so and so debenture or so and so share. What they will do is they will then find a suitable seller. All right. They, through the exchange medium, will find a suitable seller who wants to sell an instrument. If I want to buy, then I need somebody who wants to sell on the opposite side, right? So they will actually find a suitable seller, and then the trade takes place at a particular transaction, which is okay for me as well as the seller. Now, this for determining the transaction price, finding a suitable seller, all that is being done by the exchange. All right, all that is being done by the National Stock Exchange or the Bombay Stock Exchange, which are the two famous exchanges that we have in India. Now, because I'm using the broker, obviously the broker is going to charge some fees for me. All right. So over and above the transaction price, I am also going to pay some brokerage fees. All right. The initial price that I paid was for the security, but over and above that, I also have to pay the broker because he was acting as an intermediary. All right. He was acting as an intermediary for me to find a corresponding seller to enable me to place an order on the exchange he actually acted as a facilitator, and therefore I'm actually supposed to pay some brokerage to him. So typically, this is how the mode of acquisition operates. This is true for both debt and equity. Just repeating myself. So debt and equity, you can think of it as they're traded on an exchange. Are they necessarily always traded on an exchange? The answer is no. But typically in an Indian context, that is how we actually imagine generally. All right. So they're traded on an exchange. We have some specified brokers. I have to go to the broker, and then I will have to tell him that I want to purchase X or Y instrument. He will find a corresponding seller through the exchange medium, and then I will receive the security. I pay the money and I will receive the security. And because the broker is acting as an intermediary, he is going to charge some amount from me, and I will have to pay the broker an X percentage. Typically, let's say I pay him 1% of the transaction price. If the transaction price is say 1 lakh, 1% of 1 lakh, which is 1,000 rupees, I will pay to the broker. So the cash outflow for me is 1 lakh 1,000. I paid 1 lakh for buying the instrument, and I paid an additional 1,000 to the broker. So the cash outflow for me is 1 lakh 1,000 rupees. Now, similarly, when I'm selling an instrument also, the modus operandi is the same. What will happen is I will go to the broker and I will tell him that I want to sell these securities. I want to sell 100 shares of Infosys. This time the broker will find a corresponding buyer. All right. The broker through the exchange will find a corresponding buyer. And because I want to sell, he's now finding a corresponding buyer. All right. Let us say if the sale price is determined to be 1 lakh, and if this time the broker is charging 1% again, then out of the 1 lakh proceeds, I have to pay 1,000 to the broker. All right. So the broker is benefiting both when I'm purchasing as well as when I'm selling. All right. When I'm purchasing, I have to pay broker 1,000 rupees. When I'm selling also, I have to pay broker 1,000 rupees. So when I'm selling, if the sale proceeds are 1 lakh, out of the 1 lakh, I will have to pay 1,000 rupees to the broker, and that is the brokerage fee, that which is his income and my expense. So if you think of it, brokerage is a double whammy for me. I pay to him at the time of purchase as well as at the time of sale. That is how the mode of acquisition or sale typically takes place. Now, given that I've actually said that debt and equity are traded on an exchange, what you actually see on an exchange is the market price of that debt or equity instruments. What you typically see on the exchange is the market price. What does that market price means? That market price is nothing but the last traded price, which means when you are seeing the exchange screen, if the price, let us say, is 935, you are now seeing the exchange screen, the price is 935, which means the last trade that happened for this particular share happened at 935 rupees. Or let's say, for hypothetically as an example, say the price of Infosys that you're seeing on an exchange is 935, which means a moment ago or the last trade, whenever that last trade actually happened, it happened at a price of 935. You might not have entered it at 935, but somebody in the world had entered into that particular trade. They purchased and sold at 935. So that is the last traded price. This market price keeps going up and down. All right. Just like how the real estate value keeps going up and down, over here also the share and the equity share and the debt instruments. Remember, even the debt instruments price keeps going up and down. Nothing is constant. Just because it's a debt instrument, if you're presuming that the price remains flat, the answer is no. Debt and equity, both of them actually keep going up and down. All right. So what I want you to remember is market price is nothing but the last traded price, the price that you see on the exchange screen, and it is subject to fluctuation. All right. Just because you purchase the debt instrument today at 102, does it mean that the value will be 102 throughout? The answer is no. The 102 might go up to 110, or it might come down to say 90. All right. Obviously, debt is less volatile than equity. Debt is less fluctuating than equity. Equity is more volatile, but there are still going to be movements in debt instruments also. All right. So these were the two features that I first wanted to discuss. And obviously, another feature that you probably already know is we have a concept called nominal value or par value or face value. All right. Nominal value or face value. What I want to clarify is when you are going and buying an instrument in the market price is not more often than not 99.99%, the market price is not going to be equal to the nominal value. The market price is generally not going to be equal to the nominal value or the face value. All right, we will not be using the word par value much, but I've just written it over here. We'll typically use the word nominal value in this chapter. The market price is going to be completely different from the nominal value, but the nominal value is of use to us for the purpose of interest calculation. For the purpose of calculating the interest that you're going to receive from the company, your market price is irrelevant. What is relevant is actually the nominal value. Let us take an example. Let us say there is a debt instrument whose face value or nominal value is 1000 rupees. You have purchased it at 1080. Face value 1000 rupees. You have purchased it at 1080 rupees. Let's say the coupon rate is 10%. All right, the coupon rate is 10%. The company is going to pay you 10% of 1000 rupees. The company will be paying you 10% of nominal value, not 10% of market price. So what you're actually going to receive as coupon is 1000 multiplied by 10%, which is equal to 100 rupees. All right. So nominal value or face value is never going to be equal to the market price. You will transact in the market whenever you're buying or selling, you will more often than not transact at a price which is different from nominal value or face value. But the nominal value is relevant for us for the purpose of calculating interest. All right, for the purpose of calculating interest and for the purpose of calculating dividend also, what is relevant is the nominal or face value. All right, dividend as a percentage also is always expressed as a percentage of face value. All right, if a company is declaring a dividend of say 20%, that 20% is supposed to be applied on face value. All right, it's always supposed to be applied on face value. So these are the broad features that I actually wanted to discuss. Quickly summarizing, first one was the mode of acquisition, where I am involving myself with the broker. Through the exchange, I'm finding a corresponding counterparty, and then I'm actually going to deal. Now, when I'm purchasing, I have to pay additional brokerage. When I'm selling a security, from what I receive, I again have to pay brokerage. So the net proceeds I'm going to receive is going to be lower than the actual sale price. All right. Then we have the concept of market price or market value, which keeps fluctuating every time a trade takes place. Just because the last trade happened at 9:35, is there a guarantee that the next trade will also happen at 9:35? The answer is no. It can happen at 9:36, it can happen at 9:34, it can happen at 900, it can happen at 1000 if there is a big news that has come in, right? The market price is going to change based on the information that is actually coming in the market. Let us say if Infosys has made massive profits, great profits and all that, then the market price will shoot up from 9:35 to 1000. If Infosys has made bad losses, then the market price will actually crash down. All right. So just because the last trade happened at 9:35 doesn't mean that the next trade will also happen at 9:35. All right. So the price will keep changing as and when trades are happening at different prices. Then the concept of nominal value or face value, which we just discussed. All right. So these are the features. Now, AS 13 classifies all investments into two categories. One is called current investment. The other is not called non-current. It is called long-term investment. All right. Generally, you would presume that opposite of current is non-current. They have called it as long-term investment. All right. I am going to refer to current investment as CI. All right. The short form is CI. Now, what is a current investment? A current investment is one which is readily realizable and where my intent of holding is for a period of less than 1 year. I have purchased the security with an intent of holding it for less than 1 year or 12 months. All right. So something which is readily realizable and where my intent of holding or the intent when I purchased a particular security, my intent was to hold it for a period less than 1 year. Example, I have purchased shares of Reliance. I am going to actually hold it for say 1 month. All right. I will be selling it after 1 month. That is going to be classified as a current investment because my intention of holding it is for less than 1 year. And it is readily realizable in the form that it is actually traded on an exchange. Whenever I decide to sell, I can go and actually sell it in the market. All right. So that is, I mean, readily realizable is not something that we are going to much dwell upon, but the intent of holding is something that we are actually going to look into in further detail. So anything where the intent of holding is less than 1 year is going to be treated as a current investment. Anything which is not a current investment is going to be treated as a long-term investment. Long-term investment is anything that is not a current investment. So if I flip the definition around, any instrument where my intent is to hold it for more than 1 year, where I've purchased a particular instrument with an intention of holding it for more than 1 year, that will be regarded as a long-term investment. Example again, say I've purchased shares of Reliance. All right, my intent is to hold it for say 7 years, 8 years. It's a long-term strategy. I mean, it's a long-term investment. I would like to, make gains through capital appreciation over the long run. All right, I believe that Reliance will probably double or triple its money over a 7-year period or an 8-year period, and therefore I don't have an intent to sell it. I don't have an intent to sell it in the next 12 months. I intend to hold it beyond 12 months. That is going to be classified as a long-term investment. There is no separate definition of long-term investment, or rather, the definition of long-term investment given in AS 13 itself is anything that is not current is going to be treated as a long-term investment. All right, current investment is anything which is readily realizable and where my intent is to hold it for a period less than 12 months, which means I intend to sell or dispose of the security within a period of 12 months. I've purchased a bond today to dispose it off within a period of 12 months. That is a current investment. If I've purchased a bond to hold it up to its maturity, say I've purchased a Government of India bond, whose maturity is say 10 years, and I want to hold it up to 10 years. That is going to be treated as a long-term investment because my intent is to hold it for more than 1 year. Now, one point that I would like to actually bring to your notice is the intent of holding. The calculation of 12 months is being done from the date of purchase and not from the balance sheet date. All right. The 12-month period calculation is being done from the date of purchase, not from the balance sheet date. Now, what is the significance of it? Let us say today is 1st April 2022. 1st April 2022, I have purchased a bond. I have purchased a bond on 1st April 2022, whose maturity is say from today 18 months. All right, whose maturity from today is say 18 months. All right, which means on 30th September 2024, today is April 23, September 24, the bond is going to reach its maturity and it will actually pay the money back. All right. Now I intend to hold it for 18 months. This is going to be classified as a long-term investment. This is going to be classified as a long-term investment because from the date of purchase, which is April 23, I intend to hold it for more than 12 months and therefore it is a long-term investment. Whereas if you actually come to the balance sheet date, the balance sheet date is going to be March 2024. The balance sheet date is going to be March 2024. On the balance sheet date, we only have 6 months remaining. On the balance sheet date, we have only 6 months remaining. You shouldn't call the investment on March 24 as a current investment. The investment is still going to be a long-term investment because for determination of current or long-term, you are not going to stand on the balance sheet date. You're going to stand on the date of purchase. You're standing on April 23. You're seeing the intent and you're classifying it as current or long term. You're not going to stand on the balance sheet date for the purpose of classifying it as current or long term. All right. You always have to look at it from the date of purchase point of view. All right. Just to repeat my example, April 23, you purchased a bond having a maturity of 18 months. So if you look at it from April 23 point on the date of purchase point of view, it is going to be classified as a long-term investment, which is actually correct. It is incorrect for you to stand on the balance sheet date, which is March 24. After 1 year elapses on March 24, if you stand and see, you only have 6 months remaining. You should not look at it that way and classify it as current. You shouldn't be doing that. Rather, you should actually classify it as long-term investment. All right. Now, long-term investment, like I said, the definition is that anything that is not current investment is going to be classified as a long-term investment. Now, this was a brief introduction on AS 13. We have not gone into the accounting yet. I will pause this. I will stop this recording at this point. In the next session, we'll actually go through the journal entries. All right. We've actually not even started with the accounting. That is the core part of this. That is the core part of the chapter. Obviously, we're going to learn the accounting or preparation of a ledger for investment account. When you buy a share, what is the ledger account, or what are the journal entries that you might actually have to post? What are the journal entries that you will have to post on account of purchase, on account of dividend income, on account of rights issue, bonus issue, and so on. Similarly, for debentures, you're going to actually understand what is X interest, cum interest, how do you recognize interest income, how do you value it on a balance sheet date, and so on and so forth. We'll actually do the discussion first for debt instruments, and then we'll follow it with equity instruments. All right, that's it for this lecture, guys. Thank you so much. Bye bye.